Hello, Joseph Noy here, connecting with you on Zoom. Thank you to all the members who participated at our Treasury Investment Managers 2 2020 second half meeting. Your sharing and learning on what to do with rising levels of excess cash was inspirational. A big thanks to DWS too for supporting the exchanges with their own insight. Here are a few takeaways I wanted to share. First, returning prime funds to primacy. Members are still skeptical of prime funds, yet they would not have been sorry had they kept their cash in them through the COVID crisis. Prime funds would be helped going forward by some tweaks to the money market reform regulations concerning gates and fees, plus a pickup in CP issuance next year. However, what prime funds may really need is a publicity campaign highlighting how well they did in the COVID crisis and detailing the sources of liquidity at their disposal, including the Fed. SMAs to screen holdings for unique corporate risk preferences, meanwhile, will continue to proliferate. Second, social impact screens on debt. The sophistication of ESG, including social investment options, continues to grow. For corporates able to extend their cash investments to asset classes such as muni bonds or mortgage or other asset-backed securities, asset managers are making it easier for you to select bonds or securities tied to specific social impact projects or communities. Whereas in the past, this cherry picking was employed to maximize risk-adjusted return or to mitigate credit risk, now it can be used to micro-target communities and projects that companies want to support in line with their ESG, D&I, or CSR initiatives with their excess cash. Credit risk concerns don't disappear, especially under CECL, however. While yield benchmarks are easier to beat, preservation of principal is still a priority. Finally, balancing financial with impact metrics. Corporate cash investors continue to care deeply about their fiduciary responsibilities as they look to invest cash for positive social impacts. Better standards for and consensus on frameworks and metrics for social impact investments are needed. Then corporate treasuries will need to incorporate them into policies and procedures governing cash investment. And it will be interesting to see what, if any, ESG metrics rise to the level of financial benchmarks after member policy and procedures projects that many are launching or planning to through first half of next year are completed. That's it for me, Joseph Noy, connecting with you on Zoom. For more insights like these validated by NeuGroup members, visit neugroup.com. Stay safe and well.